Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at three top-ranked cheap stocks from the broader retail sector to consider buying at the moment as the market continued to rip higher to end last week, even though we saw a little bit of setbacks on Monday morning. But before we get into everything, I want to say to remember, subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So as I mentioned, stocks pulled back a bit on Monday morning after all three major U.S. indexes had surged higher last week. So we're going to quickly just review the broader market and the bullish sentiment despite the pullback on Monday morning before we dive into these three stocks. So the NASDAQ has popped roughly 8% since March 30th to outpace the S&P 500's run to start the second quarter as the tech-heavy index inches within touching distance of its records just over a month after it fell into a correction. So the fall from those mid-February highs did coincide with that wave of bond selling that we saw and had some on Wall Street worried that technology stocks were due for a huge downturn. But things changed pretty quickly. The NASDAQ had recovered roughly all of those losses, or nearly all of those losses by the end of last week, which were perhaps more about profit-taking than a true shift in the fundamental view in real inflation worries. It also turns out that some of that bond selling that sent U.S. Treasury yields climbing was driven by Japanese banks and insurers trying to lock in returns to end their fiscal years. So clearly there are real concerns, though, about the possibility of rising prices as the vaccine push continues in the U.S. and the economy reopens. But inflation worries have failed to materialize for years, and bond yields have slipped recently. So the bull case for the market and the economy is really hard to swim against at the moment. The economic reopening coupled with that pent-up demand has economists projecting U.S. GDP will grow by 6.4% or higher in 2021, which would be its strongest expansion in over 30 years. Meanwhile, the U.S. government has pumped trillions of dollars into the economy with plans for more, and the Fed is committed to its easy money policies for the foreseeable future, and a change in its preemptive approach means that rates could stay low even if the economic boom really, really heats up. And plus, U.S. Treasury yields are historically low, considering that the 10-year yield went above 3% as recently as 2018, and it hit above 5% back in 2006. So it's hovering at about 1.6% at the moment to give you a sense of where things are. So this means Wall Street's likely to keep chasing returns in that there is no alternative market. So on top of all of this, Goldman Sachs and JP Morgan Chase and others posted blowout results to start the unofficial start of Q1 earnings season last week. So we saw JP Morgan's CEO, Jamie Dimon, also has said recently that he could see the economic boom lasting until 2023. So the next couple of years could be a big, big boom for the U.S. economy. So before we jump into these three, I just want to quickly look at the broader earnings picture that's continued to improve. So right now we're calling for Q1 S&P 500 earnings to jump over 27%, and this is a continued improving figure. As we mentioned, the big banks have come in hot as well on 6.2% higher revenue, and then we're calling for massive growth in the second quarter against that easy to compare period from the year ago. So overall, we're calling for 26% earnings growth this year for the S&P 500 on 8% higher revenues, with another 14% earnings growth expected in 2022 on about 6.5% higher revenues, and then even more growth the year after that. So those outlook Jamie Dimon's talking about is also showing up in our earnings outlook as well. So with this as the backdrop, we're going to take a look at these three highly ranked stocks that are all trading for under $30 a share that investors might want to consider as the market continues its bullish sentiment. And the first stock we're looking at is Levi Strauss. That trades under the ticker LEVI. So Levi. Levi is a fashion icon. It's famous for its jeans, and the company returned to the public markets back in 2019, and its stock price has soared about 140% in the past year. This has seen it crush the likes of Nike and Lululemon and a lot of other apparel retailers. Levi owns other brands as well, and Wall Street has been pretty pleased with its initiatives within the changing retail and fashion landscape. And most recently, it topped our Q1 earnings and revenue estimates on April 8th. So quickly, we'll just do a little bit of broader, simplified overview of Levi and then leave you with what to expect going forward. So Levi, as I mentioned, is a global fashion brand. It's various offerings for men, women, and kids. It's found in chain retailers, department stores, online sites, and its global footprint of approximately 3,100 retail stores and shop-in-shops. Beyond its namesake clothing brand, Levi also owns Dockers and some other brands as well. And the company pulled in about $4.5 billion in 2020 sales, which actually marked a 23% downturn, which was heavily driven by those coronavirus setbacks. Luckily, Levi's sales have improved as economies reopened, with its Q1 revenue down just about 13% versus a 62% decline in the second quarter of 2020. Like many retailers, the company has spent the last year improving its digital business, with its most recent quarter e-commerce revenue up 41% to account for about 26% of total sales, up from 16% in the year ago period. Despite these setbacks, Levi, as we mentioned, has topped our adjusted earnings estimates in the trailing 4 quarters by an average of about 54%. The iconic jean makers also focus on diversifying beyond denim pants, especially amid those changing fashion habits. We've talked about Lululemon a lot in this show, in the rise of athleisure. So this is a quote from the company's actually fourth quarter earnings call. But in 2015, our tops business represented 11% of our total business. In 2020, it was 21%. So they're really trying to expand beyond just denim to broaden their horizon. And then, as we mentioned, they're just going to try to get beyond that denim, what they call denim bottoms business, into other categories. With this in mind, Levi's has pushed to expand its reach as malls and traditional department stores such as Macy's and fade a little bit in that Amazon age. This includes a beefed up partnerships with the likes of Target, and features its recently launched lifestyle collection that ranges from home good products and pet supplies. So that's just another aspect of Levi getting beyond this traditional denim jeans business. So as we mentioned at the top, though, as well, Levi's stock has been doing really well. It's up about 130% in the past year and 145% in 2021. This run has helped it climb above its IPO levels, with it now up around 30% since its debut in March of 2019. As the market dipped Monday morning, the last time I looked, Levi shares had popped to reach a new record of over $29 a share. And we should note that the company announced last quarter that it reinstated its dividends as the economy returns to normal following coronavirus setbacks. The company then said when it released its Q1 results that it raised its second quarter dividend to while it's also raising its outlook. So that's a positive sign as well. So at the moment, our Zacks estimates are calling for its full year 2021 revenue to jump over 24% to $5.5 billion, with 2022 set to jump another 10% to about $6.1 billion. And we should note that this would see the company top 2019's revenue total, so getting back to that big growth. And then on the bottom line, we're calling for Levi to jump from adjusted earnings of 21 cents per share a year ago all the way up to $1.11 per share. So a 430% jump on the bottom line. And then we're calling for another 20% jump next year. So some really big bottom line positivity. And these positive earnings estimate revisions help it land a Zacks rank #1 strong buy. It also has a B grade for growth and momentum in our style score system. Plus, 3 out of the 4 brokerage recommendations Zacks has for Levi's are strong buy, with another at a buy. Therefore, investors might want to consider buying Levi as a longer-term play, though it might be prudent to wait for it to cool down a little bit as it's surged in 2021 and following its earnings release. But it's trading under that $30 threshold, and as more economies start to reopen and people are getting out of their houses again, maybe they're going to stop wanting to dress so casually with sweatpants and all of that other athleisure wear. So it's certainly worth considering Levi as a Zacks rank #1 strong buy at the moment. And now we're going to transition to another retailer, and that is Ethan Allen Interiors. It is trades under the ticker ETH, and it is a home furnishing retailer that also provides interior design services as well. So the stock has been an impressive run in the last year, and in 2021, it is set to benefit from the continued housing market boom and growth in the overall home spending market. And as we mentioned with all these stocks, it is trading for under $30 a share, and it boasts a pretty solid dividend yield. And we'll get into all of that. So Ethan Allen's 2020 sales, which was for the period for it that ended in June, the end of June, fell 21%. This was driven, as the story continues, by coronavirus setbacks, but the company has turned things around, and it's stronger than projected guidance that it provided in late January helps it grab a Zacks rank number one strong buy at the moment. So Zacks estimates are calling for Ethan Allen's fiscal 2021 revenue to jump 14%, with 2022 set to climb another 6% higher to about $708 million. And at the bottom end, its adjusted earnings are expected to soar 310% this year to hit $2.12 per share, and then climb again next year as well. We should also note that Ethan Allen earns a B grade for growth and an A for momentum in our Strauss system, and it trades at a discount to our retail and home furnishing space that sits in the top 4% of our over 250 Zacks industries. This has been a really strong industry for all of 2021, and as that housing market has continued to boom, this includes Williams and Sonoma, RH, used to be called Restoration Hardware, Tempur Sealy, and a bunch of others. So all these companies are prepared to continue to benefit from that housing market boom, which is now finally being driven also by millennials. So it's going to have legs beyond the pandemic as well, and that broader home improvement spending, as people who have been spending time at home realize, why not spend a little bit of the money we're not spending anywhere else on making our where we live a little bit nicer. So with this in mind, the stock has soared 200% since this time last year, and it's soared about 45% in 2021 to blow away the S&P 500's 13% climb. And despite this impressive run, the stock is trading at about $29 a share, which is right near its 52-week highs, but it still has about 20% more room to run before it would hit to where it was trading back in 2016. And we should also note that, as we mentioned, Ethan Allen lifted its quarterly dividend by 20% last year, and its current yield is 3.4%, which is really impressive. That more than doubles the S&P 500's 1.3% average, and it crushes the 10-year U.S. Treasuries 1.6%, and the 30-year U.S. Treasuries 2.2%. So at 3.4%, that's a really impressive dividend yield for a stock that's been on a really strong run over the last year and is trading for under $30 a share. The company also, we should note, that ended Q2 with a strong balance sheet that included cash on hand of about $80 million in no outstanding debt. So solid balance sheet for Ethan Allen. And we should note that it's set to release its third quarter fiscal 2021 results, on Thursday, April 29th. And we're going to close with another strong retail stock that's trading for under $30 a share, and that is Mattel. It trades under the ticker MAT. Mattel is a historic toys and games maker with a portfolio that includes Barbie, Hot Wheels, Fisher-Price, and much more. The company topped our Q4 earnings and revenue estimates back in early February, with its sales up 10% for the second quarter in a row. The recent growth has marked its strongest in years, as traditional toy and game companies struggled to adapt to a tech-heavy world with video games and smartphones, and just everyone handing their kids iPads at a young age. But Mattel executives said they are seeing higher than expected demand as people try to find new ways to entertain their kids and families, certainly during the coronavirus, which will hopefully translate for Mattel to longer-term growth. Mattel's growth outlook has also suggested that there could be an active push among some parents to have their kids spend less time on screens in a world where people are largely addicted to their devices. The company is also set to roll out more movies and TV shows. The company has said last quarter that we gained global market share and continue to transform Mattel into what it calls an IP-driven, high-performing toy company. So they're trying to make more content based on the different companies that they own, from Barbies to Hot Wheels and beyond. So with this in mind, our Zacks estimates are calling for the company's current full-year revenue to jump over 5% to about $4.8 billion, with another 4% growth expected next year. And then on the bottom line, we're calling for 43% growth this year, and then another 30% growth next year. Analysts have raised their earnings estimates on the back of our stronger than projected outlook. with both of its FY21 and FY 2022 estimates up about 45% since its last report. So this positivity helps Mattel grab a Zacks ranked number one strong buy. The stock also sports an A grade for growth and momentum in our style score system. Matt's shares are up 20% in 2021, and this jump is part of a larger climb that's seen it climb 130% in the last 12 months. This has destroyed its highly ranked toys and games industry that includes Take-Two Interactive, Hasbro, and others that have climbed just 40% in the last year. So they're up 130% compared to that highly ranked industry's 40% climb. As of early Monday morning, the stock was up about 2%. It hit nearly $21 a share, which is about 5% off its recent highs. Despite its outperformance, Mattel is trading at a discount to its industry in terms of forward 12-month sales at about 1.5 times forward sales versus its industry's 5.9 average. So a really solid valuation there as well. The stock also still has plenty of potential runway before it closes in on the $33 a share that it traded at back in 2016. And we should note that it touched $45 a share all the way back in 2013. So at around $21 per share, it's trading at what most people would consider a cheap price, and it's traded all the way at $45 back in 2013. Mattel is set to release its first quarter 2021 financial results on Thursday, April 22nd, so later this week. And we should know that it's topped our bottom line estimates by 67% last quarter, 150% the quarter before that, and about 32% the quarter before that. So the last 3 quarters, the company has crushed our bottom line estimates. So there could be another big beat maybe coming when it reports later this week. But like all these stocks, it's certainly worth considering as a cheaper retail play that's trading for under $30 a share. And that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.